Everyone, and welcome to step one of understanding if an annuity is appropriate for you. First of all, let's ask, why do people buy annuities? Well, for most people, the answer will be safety. Some people might say that they want it for income or protection from market volatility. Some people might say that they buy them for the guarantees, but in the end, most of those answers trace back to wanting a safe and reliable place for their savings. So, since this is a priority for most people, we have to ask, are all annuities safe? And the answer to that is no. Some annuities will keep your money secure, and some of them will place your funds at risk. But let's understand what's considered secure and what's considered risk. Secure means that the insurance company will say that if you give them $100,000, they're saying that even if the market crashes, you'll still have $100,000 in your account. If it's considered to be at risk, the insurance company is saying we cannot guarantee that your money will still be there at any point in time in the future. The next part is, what would happen if the insurance company becomes insolvent? Well, with secure annuities, there's another layer of protection to make sure that people don't lose all of their money. With the unsecure annuities, you don't have that protection. We know that every annuity, no matter what type or category it is, we know that they're all going to do the same basic thing. They're going to take a certain amount of your dollars, and in exchange, they're going to produce a certain level of income that's guaranteed for life, right? So that's going to apply to all annuities. The difference is, one of them will take some of your dollars and it'll pay you a certain amount, while another annuity will take the exact same dollars and it'll pay you more. So when it comes down to finding the best annuity, well, what we want is we want the one that pays the most, the one that has the best result for every dollar that we're giving them. So what you're buying with your annuity is what makes the biggest difference in the end result and the security of the annuity. So in the course of trying to investigate annuities, there's really just going to be two types of annuities that you're most likely going to be offered or that you'll hear about from all of the financial people that you'll meet out there. So the first, and this will be the most common, is the variable annuity. And this one is probably going to be offered to you more often than not. So let's talk really simply about what a variable annuity is and what it's supposed to do. What a variable annuity is a tool that allows you to invest in a number of different options. So inside of the variable annuity, you'll be allowed to choose, most likely from 200 or 300 different funds that you can invest in. So these funds are proprietary. They're called sub-accounts, and they're inside of your annuity contract. And they really function just like mutual funds, but in this case, mutual funds that the insurance company has gathered and made exclusively available to you inside of their account. So the value of your account will be directly related to how those funds perform, positively or negatively. This will most likely be referred to as an uncapped annuity because there's no limit to how much you can earn in any given year, and that's one of the main selling features. You get exactly what those funds do minus whatever fee the insurance company is charging you for owning the annuity. So in this case, we know that the average mutual fund fee on its own has a fee of about 0.7%, while the average variable annuity fee is 3.6%. So what does the rest of that fee go to, or what does it buy you? Well, the rest is part of what the insurance company charges in order to provide you with a guarantee of income inside of an annuity where your principal is at risk. So if the market does this and it shoots up, you'll get exactly that minus whatever fee you're paying to be in the account. So what the insurance company says is that even if those investments were to have large losses, even if you lose a great portion of the value of your account, the insurance company will still guarantee a certain level of income for life. So the most attractive part about the variable annuity is that the sky's the limit, or that there is no limit really. You can make tons of money in your investments if they perform well. And even if you lose a bunch of your money, the safety net is that the insurance company will still pay you something. So that's the main selling feature for the variable annuity. So this income function of the variable annuity is something that's fairly recent to variable annuities, it didn't always do that. They didn't always perform that way. The variable annuity, by design, had a very specific function. It was supposed to be used for holding cash. So the type of money that someone should be putting into a variable annuity is money that you've already paid tax on. Basically, money that's not inside of a 401k or not inside of an IRA. Keep in mind that the insurance company will definitely allow you to place 401k or IRA money into an annuity, but that's not really the primary function. By design, variable annuities are supposed to be for cash. The major selling feature is that the money grows tax deferred. That's the purpose of it. So if you have a 401k or an IRA, you don't need a variable annuity to give you tax deferral. Those accounts just do that on their own. So no matter where you put your IRA or where you choose to invest it, it'll be tax deferred until you take that money out. So the reason variable annuities used to be very, very popular is that if you were, let's say, a high income earner, let's say you were earning enough income every year and you were maxing out your 401k or IRA contributions. There's only a certain amount that you can put in them each year. You had all of this cash left over and you still wanted to invest. You wanted to buy mutual funds or stocks or whatever it might have been. You didn't want to be taxed every year or every time it grew, right? So what you did was you put that cash inside of a variable annuity. Now you had the option to choose from all of these different funds, and you could move your money around as much as you want and as often as you want, and you didn't have to pay tax while it grew. Tax deferred growth, that was kind of a big deal. So between 1982 and 2000, we know that the S&P gained something like 1,100%. At the same time, the NASDAQ gained more than 2,000%. So if you were a high income earner during these times, you didn't want to take your cash and put it directly into mutual funds because you were making money at the rate of 1,000% every 18 years or 2,000% every 18 years. You would have been paying a ton of capital gains tax along the way. Also, variable annuities had no limit to how much you can put in them. So you could put in as much money as you wanted into a tax-deferred vehicle and keep that money that would have gone to tax. You have the money working for you instead. It sounds like a really good deal in that case. So we have to understand that the biggest risk to the insurance company is that the value of the account will go down a great deal because of a bad year, and the insurance company would still have to pay income for the rest of your life. That's the scariest scenario that the insurance company can think of. Keep in mind that you get to choose your own investments. If we have a 2000 or a 2008 all over again, you might lose 40% of your balance. Although you would still have some income, that's a pretty good deal. For the insurance company, this is a terrible deal because the balance has now declined by 40%. Remember, they make their money on the fees. So essentially the fees being collected also declined by 40%, and they're still on the hook to make this payment to you for the rest of your life. The selling point here is that you can take all of the risk you want and you can have some sort of safety net. The downside of this is that you have to pay for that safety net. So the guaranteed income portion of the annuity is where a large part of that fee is going. So if you're making enough money, like 2013 where the market goes up some 30%, paying 3.6% in fee isn't really a big deal. Now, if the market is flat for 1 year and now you still have to pay your 3.6% in fee, that doesn't sound like a lot of fun. Or if the market declines by 2% and now you're paying a 3.6% fee, you can see that if you're taking income on top of that, you'll be at zero pretty quickly because all of these things are working against you. So the positives of variable annuities are that you have unlimited growth potential. The downside is those fees that you have to pay for the insurance company to provide you the safety net. Those can get pretty expensive. One way to look at it is that the higher the fee for the account, then usually the higher the risk there is for the insurance company to provide you with a service. So in this case, there's a high risk that the balance can go down and the insurance company would still have to pay. So you help offset that risk by paying a fee. In some cases, the insurance company will force you to annuitize in order to get the guaranteed income. So what does annuitize mean? It means that we are surrendering the total value of the account in exchange for the payment. This means that once we take our payment, the value of the account no longer belongs to you, it belongs to the insurance company now. That's their money. So if the insurance company finds itself in a place where they are on the hook for a large payment from an account that has lost a large part of its value, they reserve the right to remove the guaranteed income. So the bottom line is that because of the level of risk that the insurance company takes in providing you that promise of income, dollar for dollar, a variable annuity will produce less income than any other annuity out there. They simply just can't afford to commit to a high level of income. If the goal is to keep money safe and produce the most income, a variable annuity may not be the way to do it. If Bill Cosby were a financial advisor, he'd probably call them scaryable don't do-ities. So again, let's ask, why do people buy annuities? Well, one major reason why people are looking for a place where their money can be secure is because the market that those people knew and understood and had lived through, it doesn't seem to exist anymore. I know that you were told that if you saved money, if you invested wisely and conservatively, that you would be okay. You were told and most likely experienced the markets rising and seemingly having no limit to the growth that could be had. So you took that and you set expectations around it. You knew that if you made it to this point, that you should be able to retire with confidence and the dignity to know that you're self-sufficient. The difference is that the markets that you experienced during your younger years, they don't exist anymore. In the last 15 years, we've been through 2 market crashes. We've lived through a stock market that took our money, gave it back, took it again, just to finally restore what we started with some 14 or 15 years ago. If you hung in there, you should have made enough money along the way, but what you'll never get back is the time and the stress that you went through. We want to avoid stress, and this is why people look to annuities. So the second type of annuity that you'll hear about and likely be offered along the way is called the fixed indexed annuity. So let's understand how they work and what happens to the money once you put it into this annuity. The dollars that you place into a fixed index annuity will be used like this. The insurance company will take those dollars and it'll place them where they put the money for their fixed accounts. So this can be considered kind of like your piggy bank. This is the place where money is kept secure and out of harm's way. This fixed account is going to be made up of things like U.S. Treasury bonds and investment-grade corporate bonds. So that means BBB plus or better corporate bonds. These are the bonds from companies like Coca-Cola or Microsoft or the Caterpillars of the world. So we know that there is going to be some interest produced from this bond portfolio, right? It won't be a ton of interest earned because these are some of the highest quality bonds available out there. But the purpose is that the money be kept in secure places. Instead of taking that interest and just giving it right back to you, which wouldn't be much, the insurance company takes that interest and uses it to invest and track market indexes like the S&P 500 or the Dow Jones. So the annuity gets its name because fixed is where our money goes. The index will determine how much interest is earned. So let's say the index goes up. Maybe the index goes up 10%. What the insurance company will say is, share with us some of those returns, and the rest of those returns belong to you. One insurance company might say, we're going to take 3% and you can have the other 7% that was earned. That's how much you'll actually earn that year, 7%. So what the insurance company earns can have different names. Some insurance companies will say that there's a cap or a limit to earnings. Another name that you might hear or a term that you might come across is called a spread, which means the insurance company gets a set amount and you get the rest. And another term would be a participation rate. They might say that your participation rate is 50%, so you get half of whatever the index earns. Another company might say that their participation rate is 35%, so you would get 35% of whatever the index earns. That would not be as good of a deal. You want the participation rate to be high. The spread works differently. The insurance company might say that the spread is 2%. This means that the insurance company gets 2% no matter what. If the index earns 10, they get 2%, and you get the other 8. If the index earns 5%, they still get their 2%, you get the other 3. If the index earns 3%, they still get their 2%, you get the other 1%. So with spreads, you would look for a spread that is low. A cap or limit is kind of self-explanatory, but if your limit is 7% and the index does 20%, you get 7% and the insurance company gets the other 13. If the index does 8%, you get 7%, the insurance company gets 1. There's all sorts of different ways and scenarios that the contracts might use. Some use the spread, some use the cap, some use a combination of some of those 3. The bottom line is that you want to do your research to make sure that you have the best potential for earnings along the way. So eventually we're going to need that money back, right? We want income for life. That's the goal. So if the index goes up, the new money will pay for the income that we're taking out. The insurance company isn't really interested in you spending down this account. It's not really in their best interest. If this balance goes down, there's less money to work with and invest, less for them to be able to participate in those new profits. So the insurance company will do their best to help you earn interest along the way so that you're not spending down your balance in a hurry. So what would be another scenario of the same thing? Another scenario would be that the index goes down one year. Let's say that this time the index goes down by 10%. So if the index is down by 10%, how much do you think the insurance company gets to have that year from the earnings? 0. There's no new money to be shared with them. How much do you think that you make that year? The answer is 0. There's no new money made, right? So now that the index has gone down 10%, how much of your principal did you lose that year? None, right? Because our dollars were never invested in the place where the losses occurred. Remember, your money is in the fixed accounts. The markets can help you, but they can't hurt you. So what you'll see in a lot of different brochures is something that looks like this. They'll say that as the markets are moving like they have been, when the markets are moving down, you just stay flat. You don't lose anything that year. When the markets are moving up again, you can gain. So over and over again, that happens. What they're saying is that the value of your annuity can be helped by the index or by the markets, but the markets can't take anything from you. They can't hurt you. So in a down year when there's no new interest earned from the indexes, you take your income directly from your account balance. But this also means that the only reason your account balance will go down is because of the income that you took from it. Your account balance will never go down because of any outside forces. So I'm sure that everyone has heard about the guaranteed interest rates that are applied to your account. And even though it may sound like magic, we're going to understand today what it really means and what do they really do. So if you hear about this guaranteed interest rate, it might be 5% or 6%. Another company might offer 7%. And I think there's still one company out there that offers a guaranteed 10% per year. So what you're getting is something called an income rider. And you've probably heard that term before. The income rider will say that you're guaranteed a certain rate of increase in your account every year, no matter what. So in this case, let's use 7% as an example. This is where we're going to demystify what these numbers mean, because I know that reading the brochure doesn't always help clear it up. So let's say that we started our annuity with $100,000. On one side of this table, you have your account value. This is where the S&P or whatever index is being used will help you earn interest into your account. So let's say that the S&P goes up one year and your balance goes to $105,000. Now the next year, the index moves down. We know we're not going to lose anything, but we won't make any new money this year. Our balance should still be $105,000 minus whatever fee we might be paying. It should never be more than 1%. When the index goes up again, so will our account balance. Now we might have $110,000. So this goes back to how the annuity works. The index can help us but not hurt us. So while this is happening, our income rider has been chugging along the entire time. We'll use simple interest on our income rider to keep the math simple, but most will be compounding. The first year it would be 107, then 114, after that 121,000. Keep in mind that most will offer a bonus that will even give it a head start, but today we want to keep it simple and just understand the concept. Now, at the end of this time, the guaranteed income rider is worth $121,000, and your index balance is worth $110,000. If you wanted to take your money and walk away, which of these two numbers do you think we can walk away with? If you said the index value, give yourself a pat on the back. That's right. So what is this guaranteed income rider value and what does it mean? What this number represents is the number that the insurance company will use to calculate your level of income if your account does not grow to a number bigger than 121,000. That's all it really means. They say we'll do our math based off of whichever one of these is bigger. You might not actually have $121,000 in your account, but we'll pay you as if you did. If the market had done great things for you and your account balance grew to more than this amount, they would calculate your payment based on that. The next number that's really important in determining better from best is the payout rate. You might not hear about this one as often. It's not as sexy or exciting as a guaranteed 7% per year, but it's just as important. Let's say that the payout rate is 5.5%. The insurance company is saying, we'll pay you 5.5% of whichever one of these numbers is largest. So I'll give you an example of how one company might offer a 10% guaranteed rate. If the guaranteed income rider was going up by 10%, those numbers would be $110,000, $120,000, and $130,000. All things being equal, which of these would we expect to produce the best result? It would have to be the bigger number, right? But I'm sure you already know that there's a lot more to it than that. So the difference between the company that offers the 7% and the 10% guaranteed would probably come down to the payout rate. Now, if I just told you there's an annuity with a guaranteed 7% and another with a guaranteed 10%, which one would you choose? Which one would anyone choose? 10%, of course, right? Everyone would choose the bigger number. The difference would be that the 10% account would say that the payout rate is 4.5%, 1% less, and it doesn't seem like a big deal, right? It doesn't seem like that big of a difference, but the larger number is like the shiny object that distracts us from the things that are most important. When it comes down to it, the math will clear everything up and tell us where the best deal can be had. So let's do the math. $121,000 paying out at 5.5% would be $6,655. But $130,000 paying out at 4.5% would be $5,850. So you see that there's always more to it than meets the eye. I hope this makes sense for everyone. So do we really care now if the number is 7% or 10% or 3%? Not really. It's not real money being added to your account. In the end, that number is almost meaningless. So my tip for you is to just find the bottom line. We just want the best source of income from the dollars that we place into the annuity. That's really what matters. All of the other numbers can be manipulated. We can find a bigger number here and then just take it out somewhere else. The next time one of these financial people comes along and says, hey, I've got this guaranteed blobbity blue, you know better than that. You might have been skeptical before, but now you just have validation as to why you felt skeptical. But also, I'll throw you a curveball. Let's say that one company wants to pay you $6,655 and another wants to pay